everyone, and welcome to our third episode of the Real Confidence Quarterly Quarterback. I am Chuck Duraco. I am Director of Real Estate Research at Altus Group, based in Washington, D.C. We have a great guest today, Greg McKinnon. He's a PhD and Director of Research for the Pension Real Estate Association. Real quick, I'm just going to do an intro kind of on Real Confidence, just to get everyone up to speed on everything. Again, the site is realconfidence.com. When you click into here, we're going to focus again on the university aspect, and we're going to talk about the 2017 University Index. To find that from the home site, let's get back to the home site here. You're going to click on university. The first thing I want to do, though, before we get to that, is I want to give a big shout out to the University of Chicago. They are our 2016 Real Confidence University Challenge winner. They did 23.6% in total returns. Just again, bring everyone up to speed. The 2016 competition ran from July 1st, 2015 to June 30th, 2016. We are now on a calendar year for this competition, which we're going to talk about with Greg today, and then moving forward from there. So again, this competition, the 2017, will end at the end of this year in December. So to find the 2017, you click on the university button over here, and this dumps you right into the 2017 page. So here is the current competition, and we'll get into that discussion. Again, a great guest, Greg McKinnon, Director of Research with PREA. You know, Greg's been with PREA now for about 8 years. Before that, he was a professor of finance at St. Mary's in Canada. He's a Canadian. He likes hockey. I like hockey. I've known Greg for some time now. Hey, Greg, welcome to Real Confidence Quarterly Quarterback.
Hey, thanks for having me. Pleasure to be here.
Fantastic. Well, we're going to dive in today, again, focused on the 2017. The first thing I want to talk about to start is, again, the 2017 University Index. Bring everyone again up to speed on it. The way the index is created is that this is the sum of all the parts. So we have 38 schools and over 200 students participating in 2017. This is the sum of the allocation of all 38 of those teams. And what we saw basically was this trend towards the REIT sector, about 60%, as you can see right here, in total allocation. So this is $38 billion as if it was invested in real estate space. Again, almost 60% to the REIT side, 34% over to private equity. I think what really stands out to me, again, is the higher allocation to the industrial sector, and that's here on the REIT side. And if we go up here and you click to this, which is the private equity, and we look at where that larger allocation was, again, to the industrial sector overall at about 46% of the private equity portfolio. So when you kind of look at the industrial sector as a whole, you know, through 2 quarters, it was up 11.21% on the REIT side. That's not better than infrastructure, timber, or mortgage REITs. When you go to the private equity side, it was up about a little over 9%. It was the best performer out of the 5 core sectors that we see here. So my first question to Greg is, do you believe that industrial returns are sustainable for the rest of the year, and why do you or do you not feel that way?
Well, yeah, so thanks, Chuck. Things definitely look good for industrial relative to the other sort of major property types anyways, if you compare it to the kind of the 4 main, you know, retail, office, industrial, and the one I'm forgetting, apartments. Things definitely look good. We do a survey every quarter here at PREA where we ask people their forecasts for returns on different property types. And for 2017, the consensus forecast is has industrial running way ahead of the other property types in terms of total returns. And actually, going forward, it's supposed to outperform. It's expected to outperform next year and the year after as well. I think that does make sense. If you look at kind of the underlying fundamentals of industrial, you still have the increase in demand running ahead of the increase in supply, which is in some ways a little unusual in industrial because, you know, the construction cycle in industrial is shorter than some of the other property types. You know, it takes a lot less time to put up an industrial site than it does to put up an office building. So oftentimes in industrial in the past, supply has reacted to demand, you know, pretty quickly. I think in this case, you still have supply running behind demand because there has been, you know, over the last few years, a lack of financing, especially for new developments. So it's harder to get financing in place to start new developments, and that's kind of crimping the supply cycle in a sense, and keeping demand and supply at a balance. So which is a good sign for people that hold industrial. So it's certainly a very popular sector for investors these days. In REIT world, in terms of the rest of this year, I mean, things come in at a favor. It's certainly run pretty far ahead in REIT land, and I'm not making any prediction. I don't know what's going to happen over the next 6 months, say, in equities, but it's possible you could have a bit of a pullback in industrial REITs just based on the strong performance through the first half of the year.
Right, I totally agree on that. Let me give you a quick follow-up question. You talked about your industrial survey. I find that very interesting. Is that to your members? Is that most of your pension real estate investors themselves? Who do you survey? How big is that survey? Is that survey available on your site or anywhere for our viewers?
It is, well, first of all, it's available to PREA members in our sites, and okay. I'll put on my marketing hat for a second. I'm talking to universities here. So we do have an academic membership to PREA, which is pretty cost effective. So if any universities want to join as members of PREA, they get access to that and all kinds of other stuff. Who we survey are investment managers and consultants and research companies. You know, about their forecasts of both returns to real estate overall in the U.S. and sort of by property type. I'm just, guys, pulled up some specific numbers right now. So this is as of Q2. This is the last time I ran the survey.
Right.
And we had industrial expected to return 8.9%. That's on an unlevered basis, 8.9% for full year 2017, and that compares to 5.8% for office.
Right. Right. Yeah. So I think that obviously is a pretty big gap, and I guess that makes sense with the gap that we see. Greg, do you think a lot of this, you said demand outweighs supply, the financing that you brought up, do you think a lot of this is driven by this e-commerce, fulfillment, warehousing, manufacturing type aspect of it? We're not going to try to get too deep into the new administration, but I know his goal was to bring jobs back to the U.S. Jobs have been good, but I don't really see manufacturing coming back here, at the pace I think that he had planned. Do you think it's kind of, some of those aspects, or?
Well, I think the e-commerce thing, and fulfilling, delivery in 2 days and 1 day, and people are starting to talk about same-day delivery for a lot of this kind of stuff.
Right.
E-commerce is driving a lot of this, although, if you look at the overall number, e-commerce gets all the headlines. That's what everybody talks about. But it's not the majority of use of industrial space. The majority of use of industrial space is still by non-e-commerce users, like old school type users. And manufacturing in the U.S., is still a big driver, as is the economy in general, and especially imports actually tend to drive industrial demand more than exports do. So if the economy picks up and people are buying stuff, and we start to import stuff from other countries, that's got to work its way through the supply chain, and that takes up space in industrial.
Okay. Yep, I definitely agree on that aspect of it. Let's move over a little bit more and talk in more detail on some of these returns within the university index itself. Let's click on the REIT section and kind of see what we have down here in some of these allocations. It was very sporadic in the second quarter. The index for a whole, let's start with that, is up 6.8% here, 3.67% for the second quarter. Again, a little sporadic in the returns themselves. You can kind of see these here. The high, industrial, no surprise, which we were just discussing. The low was the retail side, which I don't think is a surprise either, down 7.62%. Up were kind of, the regulars. Again, apartment and industrial, we've seen this trend for really quite some time. The rest were moderate or declining. Alternatives are even inconsistent. We had some schools that were investing in infrastructure and timber. Well, infrastructure's up, timber's down. We'll talk about that as we move forward. So let me throw it back out to Greg. What do you make of this kind of spike in volatility within the REIT space? Do you see any consistencies within trends in the private equity space?
So you say spike in volatility, you mean like the diversity of returns across all the different
maybe
sectors?
Volatility isn't the right word. It is. What about this kind of this
spread?
This spread of diverse returns.
It's interesting is that really, I think, reflects what's going on, in the private space too. Because what you hear a lot of people talking about is up until, let's say, about the beginning of 2016. I mean, the real estate market as a whole was just running ahead. Things were looking great for real estate.
Correct.
And really, it was a beta play at that point. For a few years, it had been a beta play. In other words, you want to be in real estate just to be in real estate because there was a rising tide and all the boats were going up. And since that time, the market slowed down a little bit, and return expectations have come off a little bit. And you hear a lot of people talking about the fact that it's no longer good enough just to be a beta play. You have to start thinking about alpha. Okay? So all the university students out there can flip through their textbooks now and start looking that stuff up. But the basic idea is now the entire market isn't roaring ahead. So you have to put a lot more emphasis if you're going to be successful on sector selection, market selection, even particular assets and submarkets and that sort of stuff. So the idea that different sectors, some are doing well and some are doing poorly, that goes along with what's happening in the private side too, and it matches the way a lot of the strategists out there are sort of looking at the market. It's a lot more about picking the right sector now and not just picking real estate as some big hole that you can make a final money on.
Okay. Yeah. It is. It is. I mean, I think you're seeing now too, and just get your thoughts on this. I mean, it seems to be almost with, the economy has been strong, and kind of consistently with the growth, regardless of the new administration and the lack of really anything passing in that direction. But do you find that investors might still be looking just to park capital in real estate as one of the safer asset classes while we kind of feel out what's next from a political or economic standpoint?
Oh yeah, there's no doubt. Like, look at our consensus forecast or talk to any strategist. The expectation generally is that things are going to be slower over the next few years for real estate returns than they have been in the last few years.
Right.
But we're still living in a low return world, right? The 10-year Treasury still, I didn't look at it today, but 2.2 or something like that. I mean, the equity market valuations are high. The PE multiples are still really high in the S&P 500. I mean, everything looks kind of expensive. So relative to history, relative to the long-term, the long-term return on real estate, returns going forward look low. But as of today, relative to other asset classes, they still look pretty competitive, and it's a relatively low volatility asset class. So it's still attracting a lot of capital. There's no doubt about that. It's just that once that capital gets committed to real estate, people are spending a lot more time deciding exactly where to invest in real estate rather than just saying, "Hey, give me a diversified portfolio, whatever." I'm just gonna ride the wave.
Yeah, it's more difficult now, and then it's even more difficult, when you look at it from a U.S. investor in the United States, because there's so much capital flow now from foreign investors, and you see a lot of these, when some of them refer to like the Asian market coming into the U.S. that are pretty content with these low returns. And I think that just increases the difficulty of having, assets to invest in. I mean, you almost have to settle for kind of what you're going to get, as you move forward. Well, that's a good kind of segue over to the private equity side, which is a lot smoother, the appraisal-based method here. When we look at these returns, again, calmer than we saw on the REIT side. Industrial, as I mentioned, was the top performer. When you look at the 5 property sectors, and I thought this was a little interesting kind of mini trend that I saw. When you look at the 5 property sectors, 4, so let's exclude retail, had better returns in the second quarter than they did over the first. And that's a positive sign, considering when you look at the trends, and I have different graphs that I'm happy to share with anyone out there that show that these trends have kind of been downward across the board. And that's really from income and appreciation, the price in general, so on. So Greg, can you maybe attribute anything to these changes, this little spike that we saw in the first quarter? Again, as I mentioned, income seems to kind of slow down a bit and prices have reached these historic highs. Is there anything that stands out that why we might have saw this little jump?
It's a difficult question because I'm the kind of guy who kind of looks at it and says, well, one quarter doesn't make a trend. I know you can, it seems.
And I agree too. Yeah, that's why I had to use the word mini. And I didn't want to put trend at the end of it, but it just came off the tongue.
Yeah, I'm not sure I want to invest my life savings based on a mini trend, put it that way. But it has been up, and that's a good sign. But generally speaking, even if you look at last quarter's numbers, all the main property types outside of industrial, so we'll put industrial aside for a second, because it has been doing well. Yeah. All of them are up from last quarter, but they're still running below, substantially below the long run average return, and the appreciation returns are pretty slim. They're pretty meager in those things. Right. And the days of cap rate compression are probably done for this cycle anyways. So I think it's always good that the returns are up a bit in a quarter, but I think the story basically is still the same. It's lower returns than in the past going forward, and you're not going to expect to go back to what I think the long-term average return on unlevered basis in the U.S. for real estate overall is about 9%. That's from the NCREIF numbers, 9 and a bit, I think it was. I don't think we're going to get back to 9%. In the next few years anyways. So look for lower returns. It's always good to have a good quarter, but I don't think the overall story changes that much.
Okay. Let's jump over to another piece of the quadrant, and that's public debt. And the guys that I had on the first three calls, and that includes Greg here, are more equity focused, so I never hold them too much to the public debt side. And again, on top of that, there was limited allocation across the board, 4.2%. That might be the brightest 4.2% out of the entire group, though, because again, these returns, and it depends what you pick within it, have been really fantastic across the board. If you remember, you missed out on the RMBS sector in 2016. It was 28.4%. If you're missing that again, maybe in 2017 on residential mortgage-backed securities, in 2017 it's up 12.4%. For the year. Greg, I know you're maybe not a specialist on this. I don't know if you have any comments on securitized debt, but it obviously did really well. And just to add another thing, which was interesting, is that when I mentioned the 2016 University of Chicago, how did they win? They won with mortgage REITs, both home financing and commercial financing. So you kind of see this debt and these returns kind of jumping up. Again, I'm not going to hold you to it, Greg, but did you have any thoughts on that investment?
Yeah, well, let me just, like you said, I'm not a debt specialist, but I'll give you some general comments. I mean, generally speaking, the driver, this is oversimplifying things to a certain degree, but the general drivers in terms of performance, in the fixed income space, in the debt space, in real estate is going to be two things. It's the default rate, and it's going to be what's happening to interest rates. And essentially, you already talked about the economy's been doing pretty well recently. Depends who you ask, but in my opinion, it looks like that's going to continue for the next while. Right? I don't see any signs of a major recession coming in the next year or two. So you're going to continue probably to have pretty good, but not spectacular, but pretty good growth in the overall economy. So that's good for default rates. On the interest rate side, interest rates may go up a little bit. If you look at sort of 10-year treasuries and that sort of thing, you may see a little bit of an increase in interest rates, but I don't think it's going to be anything spectacular. So both those things are probably good for CMBS, RMBS, but I wouldn't expect, and I've been wrong before, and I'll be wrong again. I wouldn't expect stellar returns going forward on these asset classes, but decent returns anyway. So it's certainly a good asset class. And the other thing I'll say, I know you haven't talked about the private side, but let me just say something with the private debt side while I'm on it. One thing that we certainly noticed at PREA is that there's a growing interest from institutional investors in private debt markets. Right. Largely what they're looking at, though, is something that's not necessarily represented in the the real confidence competition. That's mezz debt type of stuff, so slightly higher risk. Essentially because there's a lot of unmet demand in that part of the capital markets. For a lot of the riskier types of debt, it used to be filled by people like banks, right, and CMBS, and because of regulations that have been put in place, Basel III and Dodd-Frank, that sort of thing, a lot of those typical sources of capital in that sector have sort of drawn back over the last few years. You got unmet demand, And the way the capital markets work, as soon as there's unmet demand for anything, someone's going to say, hey, there's money to be made here. So you've got a lot of people targeting that sector saying, I can make some pretty good risk-adjusted returns if I start to, lend on sort of to the mezz debt sector. And you've got institutional investors at the same time looking at, the potential returns. We've already been talking about this. The potential returns going forward on equity investments in real estate are getting lower. Prices are pretty high, especially in the major markets. So they're looking at ways to, bump up their returns without taking on too much risk, and that kind of leads them into this debt sector. So there's a lot more talk and a lot more interest in private debt amongst institutions these days.
Yeah, I read the same thing, and I've seen some of that. I don't follow it in the detail, maybe that you do, but I did see that there's some direction going in and taking advantage of some of that financing. I just want to tell all the listeners, too, I just want to correct something Greg said. He's been wrong a few times. He's never wrong. He's an economist and a researcher. You're never wrong. You just make adjustments. Correct, Greg?
That's right. You just have to phrase your forecast in such a way that you're going to be right no matter what.
Yes. You'll learn that, everyone, when you get out to the real world. So that's all you do. Let's jump over here to the return side then and get into the portfolios, and it's kind of the fun part of it. Let's focus on number one and number two. Congrats to University of Georgia. Up the second quarter, 8.82%. Year-to-date, 22.15%. 100% REITs, 100% infrastructure. Not the strategy that I prefer for the competition, but it's working for now. When you look at the University Index stats as a whole, so again, looking at the 38 schools, the infrastructure REIT allocation, we only had 12 schools out of 38 selected infrastructure REITs. Only made up not $2.9 billion of the entire portfolio. Highest allocation? Well, it's the University of Georgia, and that's why they're in first right now. And again, moving along pretty well and a pretty big gap. When you go into the Rice University and they look at them, they're for the second quarter at 8.37%, year-to-date 21.68%. 67 basis point gap between Georgia and Rice University. But again, these two have a sizable lead over Temple University. I think they did it with a little more diversification. I think this is almost a little humorous. They did 95% infrastructure and 5% timber. And timber is what brought you down, no pun intended. And they, in the second quarter, were down 0.09%. So that's what pulled that little bit of a gap between University of Georgia and Rice. I'm glad you did it, though, because I don't want two winners if these schools make it to the end, which there's a lot of time left, and we'll discuss some of that with Greg moving forward. But let's just go into this investment style here, Greg, and talk about a little bit in regards to these alternative or really this alternative REIT investment. How do you feel about such a remarkable return for such a niche type of sector? Let's just start there.
Well, it doesn't entirely surprise me that, infrastructure has been kind of going through the roof for the last little while. If you think back to, the election last year, end of last year, Trump got elected, big talk about tax cuts, reducing regulation, $1 trillion infrastructure plan, et cetera, et cetera. And I think there was a lot of excitement about anything with infrastructure in the name. So that, that goes a long way to explaining why infrastructure REITs have been going up a lot the first part of this year. Kind of the problem with that, though, is I really do think, even though you can talk about market efficiency and all that kind of thing, sometimes people just get too excited about stuff. It really was, I think, anything that had infrastructure in the prospectus somewhere or in the name of the company, people were putting money into because they were kind of excited about the potential for the area. But now, a little while later, the middle of 2017, you look at what's going on in Washington. And probably, people could disagree with me about this, but the potential of getting anything major done in Washington is getting close to zero at this point, certainly for this year and a lot of next year anyways.
Are you saying that because you're a Canadian? Is that why you're saying that? Or
no, listen, I got a green card. I'm supposed to be here.
All right, good. Because I couldn't agree with you more, because nothing is moving fast at all, and it is really a complete mess. But continue.
Oh, yeah.
I apologize.
But I mean, even this week, so just this week, an executive order was signed by President Trump, sort of streamlining the federal permitting process for infrastructure projects. You know what? That's all good. I'm totally in favor of reducing regulation and streamlining things. That's great, but that's a relatively small thing.
Right.
But the idea that there's going to be some gigantic $1 trillion infrastructure program that gets launched, that just ain't going to happen. And I think the other thing that kind of people forgot in the excitement about infrastructure, kind of the beginning of this year, is like specifically with regard to infrastructure REITs. The question isn't, is infrastructure a good investment, but are those particular REITs going to benefit from, any new program that does end up getting put in place? And if you look at who those REITs are, I mean, basically it's cell towers. Like you got American Tower and a couple other ones. You got one or two pipelines and one or two electricity transmission REITs. And I'm not saying those are bad investments or bad companies. They could be great. But when people are talking about some kind of infrastructure program for the U.S., the thing they got in mind is, fixing the highways, airports, ports, that kind of thing. So that money, even if it does come, isn't necessarily going to go to those particular companies.
Right. Exactly.
And then plus on the private side, on last number I saw, estimated there was in private equity funds dedicated to infrastructure, there's $150 billion worth of dry powder waiting, looking for infrastructure projects to invest in. Now that mostly in the past has always gone outside of the U.S. If something did happen in Washington and there was some kind of big program in the U.S., those private equity funds are going to come in and they're going to lap up a lot of those opportunities. I'm not saying the infrastructure REITs wouldn't benefit. I'm just saying that potentially, some of the run-up in values of those REITs the first half of this year might have been a little bit overdone. They just got caught up in the excitement, I think, a little bit. So you might expect to see some of that come off a little bit over the second half of the year.
Yeah, I totally agree with that. I think it's slightly entertaining because I think infrastructure, and we rode this one when the executives too, to go to the executive side, asking this same questions. They infrastructure was one of the top picks, and industrial. Industrial was first. I think infrastructure was pretty high too. We rode those coattails of the infrastructure talk and the new administration, and that was our release, and that's what we pushed out. And I agree with you as well. Like a lot of the REITs that are composing the infrastructure sector are not the same infrastructure that I think that the new administration is going to focus on if it ever gets passed. And when you look at the large infrastructure players that are not included in any of this in the selection, their annual returns somewhere around 12 or 13%. But again,
infrastructure can be a great investment. There's a lot of institutions.
Sure, absolutely, and it's consistent too. It's a good investment. I agree.
But typically, it's from a private side perspective, anyways. It's typically looked at as good returns, good income for a long, very long horizon investment. Making whatever the number was for the first half, I can't remember what it was an infrastructure reach it up a minute ago, but sort of
22.2% for through 2 quarters.
Right. So 22% for half a year. I'm not sure anybody should be expecting that to continue. But
I agree. So you heard it here, University of Georgia and Rice University. We wish you the best, but that's going to be tough to keep those levels up moving forward, especially considering since nothing seems to be moving forward, to add a little more heat to that infrastructure sector. Let's move on.
The students out there, grab the textbook now and look up mean reversion because that could be coming your way.
There you go. You heard it from a professor himself. Mean reversion. Look that up. There will be no quizzes. Don't worry. Let's move over to another one here. Then let's look at the University of Miami. Here, they were up from in the first quarter. I'm sure they were up 12.85%. In the second quarter, they were down 0.09%. I don't mean to throw Miami under the bus, but they did 100% REIT investment. They were in first after the first quarter, and they have dropped now to 6th place overall. Their allocation, as we can see down here, was to the timber REIT. So they did another alternative niche type sector. Timber REIT allocation, again, small. University of Miami was the largest here. So again, it's kind of not to do a Game of Thrones reference, but live by the sword, die by the sword investment strategy. This is a little bit of what we might be talking about on infrastructure as it moves forward. you know, what do you feel about this type of investment strategy? Now, you got to put two hats on here, Greg. One, it's about educating commercial real estate investing. And it's also, I know, about winning a competition. What do you feel about the strategy, this all-in approach, maybe with both hats on? Because I know you and I talked a little bit before we started recording, and I have some of your thoughts, but I'd like to hear it maybe from both sides if possible.
Yeah, well, yeah, like we talked offline before we started this, and I think we agree that, total props to the schools at the top of the list here. They back the right horse, and that in the context of this, the real confidence competition, that makes sense, right? I mean, you're either going to win or not win, so you may as well pick something and hope it does well. And if you pick the right one, you're going to do really, really well. So within the context of the competition, that makes sense to me. That's what I would do too. I would never invest my own money this way, though. As I hope everybody out there agrees.
You could retire like in 2 quarters, man. You'd be totally done. Just dump it all.
Good, or I'd lose my house, one or the other. That's the problem. I don't want to lose my house. So investing in real life, whether it's you're a pension fund or you're an institutional investor, or you're investing in your 401k or your own money outside the 401k or whatever. I mean, a lot of it's about diversification, depending on your risk tolerance, of course. But so it's not, generally speaking, I mean, you're not gambling, you're investing, so you're not sort of just hoping that one thing goes up a lot. You're picking a portfolio you think's going to do well over the long run. So certainly if you look at real estate portfolios, they're not 100% timber or 100% anything for that matter. They tend to be diversified across sort of sectors and property types and, REITs and private and all together, because they all have strengths, and, you put them all together, you get more diversified, you can take advantage of the different strengths from the different sectors you're investing in. So that's the way, and that's a longer term strategy. So it absolutely makes sense for these schools at the top here to have, made one bet. Like I said, I would do it too in the context of this competition, but, don't do that when you get your job after school, put it that way, or else you could potentially be in a lot of trouble.
Right. Yes, exactly. The odds are against you that you will hold that job for an entirely long period of time.
That's right. I mean, I've known people, not in real estate, but in just portfolio management in general, that got in trouble even though they won on their bets because they were told you just weren't diversified enough. And
right.
The response is, "Hey, but things worked out. I don't care." It's that was an appropriate way to do it. So,
right. And we're in discussion. Just to share with everyone out there, we're in discussion of maybe making some rule changes. Our committee is talking about it. We actually surveyed all the faculty that have competed in competitions over the last, I guess, 3 years or so, and the feedback that we got. There was a slight discussion on risk-adjusted returns. Greg, that's a whole nother call. We can talk about that maybe in the future because that's too complex. Yes, that's a little one. That was not a favorite. The favorite was putting some sort of max or min caps on quadrants and such. But I'll give everyone the update as the committee. When we come to making a decision. But for now, hey, it seems to be working. We'll see if you can maintain these returns moving forward. We did offer one thing though. This was a rule change for the 2016 and 2017 competition, is where we would pay out quarterly winners. So every quarter we will have a top private side of the portfolio performer and a top public side of the portfolio performer. And let's talk about them for this quarter. And that's the Indiana University. They were up the first quarter 3.96%, second quarter 5.61%. They have a nice diversification somewhat in the private equity sector that they have some breakdown. I'm sorry, it's right here. So they win $2,500 for the second quarter overall. They were diverse a little more on the regional side. They went industrial, which made sense, but at least they diversified here within the regional aspect. And let's throw one more back out to Greg. Is that what do you think of their thoughts on this regional investment? Is it always going to remain this kind of east-west dominance? I mean, this isn't just for the industrial sector. I mean, you just seem to kind of see returns on the coasts and just seem to do better. What do you see any of these trends kind of lightening up, or maybe looking into some of these other regions as prices, reach all-time highs?
Well, I'll tell you something. Let me start by saying, it's not unusual in actual institutional portfolios to see that same kind of break, not 100% industrial, obviously, but in terms of the regions, it's not
Right.
unusual to see really heavy weights on East Coast and West Coast, and a little bit, but not too much in the middle of the country. One other thing I'll say, and this isn't a critique or anything, it's just the way the world works, is, you've got to base this on, the indices that are available. So you got, West, South, Midwest, East. If you talk to actual investors in terms of geographic diversification and targeting things geographically, they don't typically think that way. Like East, I mean that could include New York, it could include Philadelphia, it could include Hartford, could include Washington D.C., and all those markets. Those are very different kind of markets. So just saying East in a lot of ways to investors doesn't really mean that much. So it's far more typical to talk about targeting markets or allocating metro level. So they'll look at, what do we think about New York? What do we think about DC? What do we think about Miami? What do we think about LA? And that sort of thing. So but I mean, unfortunately, just because of the availability of indices, you can't include that in this kind of competition. But I just wanted to throw that out there so people are aware of kind of the way people in the industry actually think about geography. It's much more on a city or metro level.
Sure.
In terms of whether or not that's where the returns are going to continue to be, is it going to always be the coasts? I think, and this, I guess, doesn't apply so much to the real confidence thing, because it's an annual thing. I'm going to talk more about long-term trends.
Right.
I think, well, in the short term, let me talk short term first. I mean, you have certainly seen a lot of capital go to the coasts, New York, San Francisco, LA, Washington, D.C., those kind of places. Because you mentioned a little while ago, foreign capital coming into the U.S. That capital, as well as a lot of domestic capital, really targets the big markets. They want to go to New York, they want to go to Washington, they want to go to San Francisco and LA. That's driven up prices there a lot. So, the cap rates are looking a lot nicer in the non-major markets, a lot of which are in the middle of the country right now, anyways. On a longer-term basis, I think what you're seeing is you're really seeing sort of a general change in the center of gravity in economic terms in the U.S. And gradually you're seeing things move away from the coasts and more towards the south and the central of the country. One interesting little statistical tidbit, the percentage of venture capital funds that are invested outside the Bay Area, because it used to be basically entirely around San Francisco, San Jose, Silicon Valley. The percentage that's invested outside the Bay Area has been increasing recently. So venture capital firms are starting to look kind of beyond just Silicon Valley when they're looking for startups. One other thing I'll mention is that, I mean, we've done some research work at PRIA, on the economy and sort of what drives it. And one of the things that really drives local economies is an educated workforce. I mean, it's the new economy. You can phrase it any way you want. It's the new economy. It's all about tech. It's all about e-commerce, that sort of thing. And education is what's needed for that. And we've been looking at census data to see which cities are increasing their educated population the most.
Okay.
And you don't see where those cities are basically the middle of the country.
Right.
So if you look where younger educated people are going, it's Texas. So it's Austin, Houston, San Antonio. It's Oklahoma City, which kind of surprised me, quite honestly, but that's what the numbers say. Denver, Salt Lake City, Nashville, right? So it's all right up sort of from Texas up north, in the middle of the country. And the older educated population is going to what I kind of call the New South. It's, Charlotte, Raleigh, Jacksonville, Florida, Dallas as well.
Okay.
So you don't see, New York, San Francisco, LA, kind of the big centers showing up in those numbers in terms of, the cities that are really increasing their educated population a lot. And there's been previous work that we've done here at PRIA that shows that increase in educated population tends to drive overall job growth, and that in turn tends to drive real estate returns. So I think long run, the middle of the country is looking good in terms of real estate returns going forward. For the next 6 months, that doesn't necessarily apply, but certainly the cap rates on in markets in the middle of the country versus the coast are looking a little bit more attractive right now as well.
Yeah, I think for one, you take that as a tip. Our 2018 participants, when we're signing up, you heard that long term, so maybe a little more next year, maybe 2019. I know long term's longer than that, but something to think about. and looking at some of the middle of the country. I think there's a couple other things too, Greg, to throw in is that, when I look at migration trends, I see a lot of migration to the markets that you're kind of mentioning. I think some of that is the cost of living as well, because it's cheaper, to go to some of these other markets. I've actually had some friends move to some other markets and explore their careers in those markets just again because it's cheaper. I'm in DC. DC is not a cheap market to be in. And then I think you also see that same cost of living and that same affordability coming from the corporate side of things. And that could go again to maybe some of this fulfillment and this warehousing and this e-commerce. It's sometimes just cheaper to do that type of business in those other markets. They can be obviously too more localized. As we start to see more in that, you talked about in the beginning, 1 day or 2 day delivery or current day delivery. Maybe that's what I should refer to it. That needs more hubs in different locations. So I think I agree with you completely. I think some of these markets are something really to watch as the big six, as I call them. Just are at prices that just, again, you can't have much more compression on cap rates.
Right. If you look where sort of young, educated people are moving, places like Nashville and Denver and Austin, I mean, those are cool cities.
And Nashville's awesome. Nashville's a fantastic market. I think that Austin is great. Austin's had so much growth. You wonder where the line stops on Austin. But yeah, I agree with you completely.
Some of them are becoming more expensive too. But I mean, yeah, if I'm 27 and have a master's degree in computer engineering or something like that, do I want to live in Manhattan? Yeah, I do want to live in Manhattan, but I don't want to have 6 roommates for the rest of my life. So I want to go somewhere that I'm going to be able to be in a cool place, and it's got music, and it's got cafes and bars and places to hang out and that kind of thing.
Sure.
But be able to have a half-decent apartment and a nice lifestyle, and that's the attraction, I think, of places like Denver and Austin and Nashville. They're, like I said, Austin and Nashville actually starting to become a little bit more expensive now, especially right. Austin, but it's still not, Manhattan by any stretch of the imagination.
No, or San Francisco. I mean, that's just blown out. I mean, it's really unbelievable to live in either of those markets, as well as probably some others we're forgetting. And you can put DC a bit on that map. DC's got a lot of supply, so the prices aren't as bad, anywhere near a San Francisco or New York, but that's another one to kind of think about. Well, hey, let's jump over to the public winner for the quarter, and that is Monmouth University. And congratulations to Monmouth. They let's get them pulled up here. They did for the second quarter 12%. Wow, how did they do that? Well, all industrial REITs. So there's the one there, industrial REITs. That beat out the University of Georgia and Rice University for the quarter. Because industrial REITs was the big performer. Don't worry, Georgia or Rice, because I will tell you now, the 2016 winner, which was the University of Chicago, as I mentioned, didn't win any quarters, but they won the entire thing and won $30,000 for the university program. So don't give up just because you haven't won a quarter. You're still in first and second. But congrats to Monmouth University. Again, industrial REITs. I don't think we need to really elaborate on it much more. I think Greg and I talked about it in pretty good detail. So congrats to Monmouth. Hopefully that can keep moving forward for you as well. So I had Greg, do the typical question here. I had him sit back and put his thinking cap on and look through some of these portfolios here, and even these ones down here, because you never know. You can't give up BYU being down 12%, but nonetheless, you had to have him take a look at all these here, and we're going to ask him the big question. Again, let me get back to this page, but the big question again would be, what do you think, in looking at these portfolios, who do you think has maybe, in his thoughts, the best opportunity to maybe pull out the $30,000 when we come to the close in December of 2017? What portfolio did you like? Maybe what didn't you like? Anything you can elaborate, Greg. These people are sitting on the edge of their seats waiting for your answer.
Yeah. People always feel like that when I'm about to talk. I'm going to answer this question. I gave this some thought. I'm going to answer this question a little bit differently. I know you want me to pick who I think is going to be the winner. I will say, listen, the guys at the top there, that made the single bets and have done well, good for them. I think that's great. I think they backed the right horse so far anyways, and maybe that'll keep on. But I was sort of looking through this list, and I thought it might be appropriate to throw a shout out to a school that's further down the list. If you want to flip all the way down, keep on going. Number 18, University of Cincinnati.
Click on their portfolio.
Now, I'm going to tell you that, don't get too excited, Cincinnati. I think the chances of you coming back from, in the last half of the year to win is, a snowball's chance in heck, I guess, at this point. But
so they have a nice little breakdown here. I see. Okay, they got a nice diversification.
So I looked at them. I said, you know what? This is in terms of having a portfolio that's relatively realistic. You say, okay, they got 40-some% in REITs.
Yep. They have 40% REITs, 55% in private, and 5% in public debt. And this is the REIT portfolio here, Greg.
Right. So they got diversification. They got a little bit of debt to provide a little bit of stability to the portfolio. Within REITs, they got a nice allocation to REITs, and within REITs, they got healthcare, storage, infrastructure, timber. So they're taking advantage of the sectors that REITs are really strong in. That's hard to get in the private space. Those tend to be specialist sectors. There's some really great REITs in those sectors, and they're harder to access in the private equity space. Then you go to the private equity part.
That's a good point. That's a very good point. Yeah, go ahead. I'm sorry.
You got a diversification across property types, overweight in industrial. That makes sense. Industrial prospects are good, and within each sector, they're geographically diversified. So, unfortunately for Cincinnati, I don't think they're going to win. I mean, it's a long way to come back. But I just wanted to say, as I went down the list, they were kind of one of the first schools I came across where I said, that's a reasonable way to go about forming a portfolio, I thought. So I'm going to give them a shout out rather than trying to pick the actual numerical winner in the end.
All right, I'm still going to claim that that's your pick for the winner. I'm still going to do it. I'm sorry. I just have to do it.
But if they do end up winning, I'm going to say that I picked them.
See, exactly. So you have to at least say that you picked them at some point. So my thing to you, which I think is more important, would be it almost sounds as if you would invest your own money into the University of Cincinnati portfolio.
If I had any money, I would do it.
So there you have it. You might be University of Cincinnati. You could be a future portfolio manager.
You can run my family office, all $100 of it.
There you go. A check might be in the mail, and invest it wisely, which we know you can do. Well, there you have it. There's another edition of Real Confidence Quarterly Quarterback. We hope you enjoyed the recorded podcast. I want to thank Greg McKinnon, PhD, Director of Research at the Pension Real Estate Association, or PREA. A lot of feedback, a lot of discussion. Congratulations to the University of Georgia and Rice, Indiana University, and Monmouth University for winning the quarterly pieces. And again, Greg, thanks for all your feedback. And we look to having another one in the future, and you'll be getting another call on this as well, Greg. So again, thanks for taking the time.
All right. Thanks very much.
Thank you.